Welcome back to another episode of Invest in You. We are continuing to look at all those fundamental financial stuff that seems to be very complicated, but isn't that complicated. In this episode, we'll be looking at the EPS, the PE, and the PEG. Don't know what they are? Stick around for this video and I'll show you exactly what they are. Okay, so let's get right into it. The most popular and most common financial ratios that everyone loves using. And that is the price to earnings ratio, the PE and the PEG. This is by far the most popular thing to quote. So when these financials come out every quarter, you'll definitely hear the PE, and most importantly, whenever someone brings in the term overvalued, undervalued, or fair value, they are talking about the PE ratio. So that's how you determine if a company is overvalued, undervalued, or fair. Yeah, so to calculate the PE ratio, you're going to take the price of the stock and you're going to divide it by the EPS, the earnings per share. Now, I prefer the PEG ratio, and all that means is, so the PE ratio has a tendency to show a stock's overvalued, but it doesn't consider what's coming up for that company. For instance, it only looks at the history of a company. So that's why you often get a PE trailing ratio. So trailing means they used historical figures. So last year, 2 years back, 5 years back, they used all those values. And then you get a forward PE. So forward PE, they look at today's earnings per share and next year's. So they usually look like a year ahead. So that's why it's forward PE. Now, the forward PE is a lot like the PEG ratio. And the only difference is, so the G stands for growth. So it accounts for the next 5 years estimated growth. And that estimated growth comes from a lot of different analysts and financial people that estimate what this company's growth might be. So that's just why the PE ratio a lot of times will show a company is overvalued. But if you don't understand that something big is coming in the pipeline, then you might think that this is a horrible company to invest in and you might miss an opportunity. For instance, Tesla. Tesla has a humongous PE ratio. Maybe not the best example, but I'm going to use it in any case. So, humongous PE ratio, you'd just be like, that's not a good idea to invest in. But then you have things coming up like Battery Day, you have all their side ventures, all their joint ventures that they're doing, and you have to look at all those things to know what this company is going to do in 5 years' time and account for that. And that's why what's happening in the market in September of 2020, all these stocks were overvalued because people kind of know what's coming up. And that's why also we have a market correction, is because all these stocks are overvalued on book. But a lot of people forget that this tech industry, this fourth industrial revolution stocks are gonna do something great in the future. So you just actually need to know what they're gonna do, and then you can account for that. So let's first go into depth into the PE ratio. The PE ratio is it's like doing shopping. When you go into the shop and you look at different types of cheeses, what's the first thing I look at it? Let's say I'm looking at all the cheddars. I'm not very fussy about what cheddar I get. So what I do is I go look at the rand per kilogram on the label, because that shows you, for instance, a cheddar could cost 120 rand per kilogram for this cheese, and for the one right next to it, it's 100 rand per kilogram. So obviously I'm going to be taking the 100 rand per kilogram cheese. So a PE ratio is a lot like this. Using the PE ratio, you can compare stocks in the industry, and you can say, listen, here I've got 2 communication stocks. This one has a better PE ratio than this one, so I'm probably going to be going for this. But then I come in and I always say that's why I don't just look at the PE ratio, because yes, this PE ratio might be great and cheaper and better, but this company is planning something big. Let's use the cheese as example again. You've got your 2 cheddars. This one is as a lower rand per kilogram and this one has higher. But now this one, you get home and it's already smelling a bit like blue cheese, not great. Where if you bought this one, it only would have smelled like blue cheese in 4 months' time. So you got to compare the inherent value of their products also. And then also, now this cheddar company is only selling in South Africa, but this company is also only selling in South Africa, but they are planning on selling in Australia and the UK and America next year. So that's why I just like using the PEG ratio, because then I know this company is spreading out and they are probably going to have a better growth. So I'll want to invest in them more. So you consider that PEG. And most commonly, the PE ratio is always the one you see. So if you don't find the PEG, you can easily go calculate it. So you take the PE ratio they take, and then somewhere there, they'll either give you a 5 years expected annual growth, or they'll just give you 1 year's annual growth. So you take that annual growth, times it by 5, or you use the 5-year one, and you just divide it into the PE ratio, and you'll get a PEG. A good PEG ratio would be less than 1, because that means it's undervalued and probably a good idea to go invest in. But again, you can't just look at 1. Then if you find a PEG of 1, it's a fair value. Greater than 1, it's overvalued, and you need to go look at it a bit more. And then what value of PE ratio should you be looking at? So typically people will tell you anything between 10 to 20 is normally like a good indication of a PE ratio. So Kathy Wood said, for instance, she likes looking at a PE ratio of 25 to 30, especially for innovation stocks and tech stocks. But then if it's a high growth stock, so you're expecting a lot of rapid growth from this company, then look at a PE ratio anything in the range from 33 to 50. So for instance, I like saying that my tech stocks, I always look between that 25 to 50 PE ratio, and then I take everything else into consideration. And if it's a company that I'm more expecting just to pay dividends and not really grow that much, I'm more looking below the 25 region for PE ratio for them. Okay, so now that you've got that down, let's move on to the next one. You'll see this on any day that they release new financials for a company, every quarter or whatever. You'll definitely hear one of the first things analysts refer to is the EPS, the earnings per share. And it's a very good indication of how good your shares are in this company and also how good this company is doing. So you'll hear a lot of the times when earnings calls come out, they say that the estimated EPS is 2.5, and then you get an actual EPS of 2.55 or something like that. So all that means is you have an analyst guessing what the EPS would be for a company, and then when they actually report it, that is the actual EPS. So EPS is a great financial indicator to show the profitability of a company. Okay, so the EPS is calculated by taking the net income of a company and dividing it by the weighted average of the outstanding shares. So now an important thing to notice is a lot of times they'll speak about earnings and they'll speak about revenue. The two are very similar to each other, but the big difference is net income is your earnings. That is your income minus your expenses. That is your earnings, your net income. Remember that. Where revenue is only the money you make from selling your products. That's only the income you get. It doesn't consider all the different expenses. And therefore you can look at your EPS as an income per share. A good EPS is always above zero. You always want to make income. You want to make money. I always say EPS is a good way of looking at it as saying the EPS shows the ability of a company to do more with less. So what do I mean by that? Suppose company A has twice as much income as B, but company A has more shares issued than company B. So therefore, if you look at these calculations, you'll see that B has a better EPS ratio, and that's because they had more shares, they got more money from shareholders to actually get that income and do more. So that's why I say it's the ability of a company to do more with less. So the less shareholders you have, the more you can do. But this is not always for all companies. This is just one side of it. Suppose now a company does have more shareholders. That does mean if they use that money correctly, they can grow much more than company B might, because company B will take a bit longer to get more money in to actually grow their company. Okay guys, that is it for this video. If you liked it, hit like, subscribe, comment down below if you want to see anything else.